All right, let's go ahead and jump in here. Before we get started, I just want to remind everybody that there is a substantial risk of financial loss in trading futures and options. There's no easy money here. We are speculating. Options of any type may not be suitable for everybody. Should you have any questions, concerns, comments about today's presentation or trading options and futures in general, or any of our services, you can contact us here. You'll find my phone number, my email address. If you're on Twitter or Facebook, check us out. @CarlyGarner is our Twitter handle. On Facebook, if you just type in DeCarly Trading, it'll come up in the search. And by the way, DeCarly Trading is a brokerage firm. That's how we make our living. We're located in Las Vegas, Nevada. We offer services from full service to discount online, everything in between. Provide our clients with daily newsletters and trade guidance and those sort of things. Somebody's asking if there is training available on our website, and actually, now that you mentioned, if you go to decarlytrading.com, we do have several free articles. We also have several videos that are posted that will help you in your trading endeavors, hopefully, give you some ideas and give you some pointers. If you're interested in reading, I've written 3 books: Commodity Options, A Trader's First Book on Commodities, and Currency Trading, the book. They're available at any major book outlet, but Amazon.com is usually the cheapest. Today we're going to talk a lot about some of the stuff that's covered in commodity options. And just as an FYI, you may or may not recognize my name, but I do write a column for Stocks and Commodities magazine, and I also write a couple of daily newsletters for our brokerage clients, the DeCarly Perspective and the Financial Futures Report. Real briefly, some of the key things that we'll be talking about today are the differences between trading options on stocks and options on futures. We're going to give you a couple tips and tricks on trading commodity options. We're going to discuss some of the benefits and disadvantages of trading long and short options. We're going to talk about break-even points and what they mean to option traders. And we're going to take a couple looks at what an example of a short option trade might look like, whether you're selling outright directional trade or you're neutral and you're selling strangles. Okay, I apologize. That previous slide should have said, what is an option? Okay, an option is an option, not really. Think again. Not all options are created equal. The mechanics of calls and puts are going to be the same whether you're trading stocks or commodities or Forex or whatever it is that you're trading, but because the underlying markets are so different, the options themselves behave much differently. Despite the fact that calls are calls and puts are puts, you really would not trade futures the same way you trade stocks. So why would you assume that you could trade their derivatives in the same manner? And you absolutely can. We're going to kind of point out a few reasons why. Some of these might seem obvious to a few of you, but sometimes it's really important to just take a step back, look at the big picture, and get an idea of what it is we really are doing here. It's easy to get caught up in the details of the day-to-day stuff and ignore the big picture. One of the primary differences between trading commodity options and trading stock options is the leverage involved. I mean, all options are really leveraged, let's face it. That's just what they are. They're a derivative which entails leverage. But commodity options are leveraged instruments that are written on leveraged instruments. So what they offer is a lot more risk and a lot more potential reward. Now, of course, everybody that trades commodity options realizes that they're written on a leveraged asset, so the market prices that in. Commodity options tend to be a little more expensive than stock options, which can be good for somebody that's perhaps selling options. Of course, it can work the other way because it can also be a nightmare if you're an option seller and volatility picks up and option premium picks up, but we'll talk a little more about that later. Okay, a big difference between trading options on futures and options on stocks is really the time limits. You'll hear a lot of stock traders say, well, I sell puts because I wouldn't mind being long the stock from X price, whatever that price happens to be. And that's great because as a stock trader, you can sell puts, and if the market goes against you and you get assigned the stock, you just hang on to it. And in general, stocks usually in the long run go higher. Well, commodities are a completely different animal. Not only do commodities not consistently go higher, they trade more in a range than a long-term uptrend, but they also have finite lifetimes. You can, for example, if you sell a put in a commodity and you get assigned the futures contract because the commodity drops below the strike price of your option, you can't just, well, in theory, you really can't just hang on to the commodity forever, the futures contract forever, and hope that it comes back for you like you would a stock, because in commodities, the futures contract is going to expire. And on top of that, the futures contract itself is leveraged, so it's just not nearly as comfortable of a position. So once again, there's more premium to be had in commodities, because but that's because there's more risk. So double-edged sword. There's good and bad. Another thing to point out, which again is pretty obvious, but people tend to overlook these sorts of things, commodities don't pay dividends, and therefore they don't have a tendency to trade in a long-term uptrend like stocks do. They trade in ranges. Another thing to keep in mind is commodity options tend to be a lot less liquid than stocks, and in addition to that, unlike the stock market in which there's hundreds or maybe even thousands of different stocks that have liquid and tradable options, in commodities you're only looking at maybe 10 to 20 markets that really anyone would have any business selling options in. And that's all because of liquidity. Trust me, you don't want to be selling options in a market that there just simply isn't anyone else around. And for that matter, I'd be a little more comfortable buying options in that kind of a market, but even so, if you, for example, copper is a good example. Copper options are extremely thin. I'm not sure why. They talk about it on TV all the time. It's pretty popular with beginning traders, but for whatever reason, copper options just don't get any trading interest. And so a lot of times what happens is people will buy an option speculating in a certain direction. The market will go their way dramatically, and on paper it looks like they're making some good money. But when they actually go to try to sell the option that they bought, there's nobody there to take the other side. And because of that, it's very possible that they could end up losing money or breaking even on a trade that on paper, on their statement, looked like they were making a lot of money. And that's a liquidity issue. So you want to avoid those types of things. If you're going to do the work and you're going to take the risk, you want to make sure there's liquidity there so that you can get in and out properly and be rewarded if you're right. Another thing to keep in mind is commodity option traders, they're really only looking to speculate in the next 2 or 3 months. And I know stock option traders are a lot different. I talk to guys that are buying leaps, a year or 2 years out, and that's great, and there's liquidity there. But in commodity options, you're going to be hard-pressed to find enough liquidity to trade actively in options beyond 2 or 3 months. I mean, some of the grains will go out a little further than that, but it's really kind of hit and miss. So you want to try to stick within 60, 90 days to expiration with your option trading in commodities. All right, somebody's asking, what's the bid-ask spread on a typical commodity option? And honestly, it just depends on the market. For example, the E-mini S&P options, the bid-ask spread is usually a quarter to 50 cents, which is, in dollar terms, that's $12.50 to 25 bucks. Some of the grains are a tick to a quarter, so in the same general price range. And then you start getting into some of the illiquid stuff. I'll bring, copper again. I've seen copper bid-ask spreads as wide as $200 or $300. So as you can imagine, if you're having to overcome a bid-ask spread of $200 or $300 on the way in and then again on the way out, it's really almost impossible to make money. At the end of this particular class, we will actually go through, which markets to kind of stick away from and which markets might be a little more viable as far as commodity option trading. Okay, the great thing, at least if you're a U.S. citizen, about trading commodity options over stock options is that you get preferential tax treatment. This is actually two-tiered. For one, you're going to get taxed on your commodity option trading at a 60-40 blend between long-term and short-term. And this is regardless of how long you're in the trade. Even if you're in the trade a day, you still get that 60-40 blend. Whereas if you're trading stock options, typically, and it depends on the product, but typically you're subject to short-term capital gains, which is taxed at a higher rate. Another benefit of commodity options is you don't have to worry about line-by-line accounting at the end of the year when you do your taxes. You're basically going to report one lump sum to the IRS. It's net of all commissions and fees and everything else. It's what you made or lost, and that's it. You don't have to tell them the details of each individual trade. One other thing to point out about the challenges of trading stock options as opposed to commodity options is most stock brokerage firms will require you to have pretty high balances for margin accounts if you're selling options at all, even if it's covered calls. They're usually wanting 50 to 100,000. In a commodity account, you could do it with quite a bit less, 10,000, 5,000. You could get away with some short option trading. Also, stock option firms a lot of times will require that you have enough money in your account to cover any assignments. Like, for example, if you're trading options and you're assigned the underlying stock because the market's gone beyond your strike price and somebody's exercised it, in some instances it requires a big chunk of cash to finance that, and stock firms a lot of times won't allow you to even put your trade on unless you have the cash to back it. So commodity option traders have a lot more leeway when it comes to account size and margining and that sort of thing. All right, so let's actually finally get into it and start talking about options. All right, most of you probably know this, so I'll be real brief, but let's just discuss it real quick so we're all on the same page. The mechanics of calls and puts. Essentially, a call option is an instrument that gives the buyer the right, but not the obligation, to buy the underlying commodity at the stated strike price within a specified period of time. Obviously, you can be a seller of a call option, and the seller is taking the opposite side of that bet. And we'll talk a little more in detail about this and actually go through an example or two. But the idea is a call option buyer is basically facing limited risk and unlimited profit potential, but the seller, on the other hand, is facing unlimited risk and limited profit potential. And I mean, to make things as simple as possible, it's a 50-50 game. Whoever buys the option is going to make or lose the exact opposite amount of the person that sells it. So for example, if you buy an option and someone else sells it to you and you make money, that person is losing the exact same amount of money. It's a zero-sum game. So in short, a call option, if you're a buyer, is a bullish strategy. If you're a seller, it's a bearish strategy. The primary difference between being a buyer and seller is the amount of leeway or room for error that you'll have. And we'll go through an example. A put option gives the buyer the right but not the obligation to sell the underlying contract at the stated strike price. In essence, the seller of a put option is obligated to deliver a short position from the strike price if the buyer chooses to exercise the option. And keep in mind, exercising is not all that bad. Option traders are often scared of being exercised, but in commodities, because like I said, everything is done on leveraged and accounts or margins, you don't necessarily have to have the full value of the underlying asset when you're exercised. So it's not really that big of a deal in commodities, although people are scared of being exercised and assigned. Usually, if you're selling an option, it's usually a good day if somebody exercises you. Not a good day, I shouldn't say that, but if somebody exercises you, it puts you in a better position than you otherwise were because it takes away all the time value of the option. If the buyer of the option exercises you, they probably don't know what they're doing unless, in some cases it makes sense. In illiquid markets it can make sense, that sort of thing, but more often than not, a buyer of an option is better off selling it as opposed to exercising it. So if you're the seller of an option and someone exercises you, they probably did you a favor. Okay, the break-even point of an option at expiration is easy to calculate. And the only reason I bring this up is because I want you to understand that the break-even point of an option at any point before expiration absolutely cannot be calculated. It can be estimated, but it cannot be calculated. And that's because it's based on time and volatility and demand, all these things that we cannot predict in the future. If we could predict them, life would be much easier, but we can't. What we can predict is at expiration what the price of the option will be if the underlying futures price is at a certain amount. And how we figure that out is we basically take the strike price, which is the price at which the buyer of the option can either buy or sell the underlying futures, the premium that was paid for the option, plus or minus the transaction cost. So if you're buying an option, for example, if you're buying a $5 call in corn and you pay 5 cents for it, which is $250, your break even is 505. So just because you buy a call and corn goes up doesn't mean you're making money. The market has to get above 505 at expiration for you to make money. And a lot of beginning traders fall in the under the assumption that if they buy a call and the market goes up, they're going to be making money, and that's absolutely not the case. The market has to go up quite a bit for a call option buyer to actually make money. And that's the idea of why, maybe selling options in some instances might be a better way to go, although it's certainly not without its challenges. Okay, let's, most people that think about option trading, they typically think about buying options. And the reason being, buying options offers you limited risk and unlimited profit potential, so it sounds really great on the surface. But as great as it sounds on the surface, in the long run, it's a really difficult game. Your timing has to be almost perfect. It doesn't leave much room for error. So what we like to push people to do is think outside the box a little bit. And even if you are going to be a long option trader, even if you prefer to buy options, you may want to consider selling options to pay for the options that you're buying. And so that might be a bull call spread where you buy a call at a certain strike price and then you sell a call higher up just to lower your risk, lower your cost, those sort of things. Or it might be just selling options naked. In a beginning class like this, we can't really go through everything. But again, if you go to decarleytrading.com, we have lots of videos that will talk about each of these different strategies, and you can decide which one might be the best for you. So all we're trying to say here is just open your eyes to the potential of both long and short options, and maybe even at the same time in the same strategy, in the same trade. And again, most speculators are lured to long-only strategies, long option strategies, because it's fabulous. They know, whatever I spend on the option is the most I could ever lose, and that's great because at least you know what your total risk is. But sometimes limited and less aren't necessarily the same thing. I mean, trust me, you can easily spend 300 here and 400 there and 200 here and all on options in which your risk is limited to whatever you paid for those, but the odds of you making money on those aren't great. So you can easily blow out an account very slowly and painfully just by buying long options and watching the time decay. So we're going to go into some details on why strictly long options maybe isn't always the great option, although there's a time and place for everything, and we'll talk about that too. And the main ideas being the 4 things that are working against long option traders are time decay, the 80-20 rule, time limits, and market direction. Time decay is the big thing. Options are an eroding asset. Each minute that passes reduces the value of any given option, and that's because the value of being able to exercise the option and go long or short the futures contract from whatever the strike price is becomes less valuable every day that goes by because there's less uncertainty. We know, for example, an option that only has 3 days to expiration, we cannot predict what the next 3 days are going to bring, but we probably have a much better idea of what those 3 days will bring as opposed to an option that has 3 months. So the option to be able to buy or sell at the strike price is far less valuable to somebody that has an option that expires soon. Buying an option is really a lot like purchasing a car. Once you drive it off the lot, the value plummets and it immediately becomes less valuable, and that is not unlike buying an option. First of all, once you buy an option, you had to overcome the bid-ask spread to get in. In most markets, that's not too traumatic, but it is something to be aware of. And then immediately, the time value just starts ticking away. And time value is going to be a factor even if you're absolutely right about the direction of the market. Again, if you buy a call option and the market goes up, that doesn't necessarily mean that you're going to make money, because if the option's not going up enough to recover the premium you paid plus the time decay, you're still going to be losing money even though you were right, and that is frustrating. The 80-20 rule. Okay, it has been said that commodity markets spend about 80% of the time trading in a range and another 20% of the time redefining that range. Now, this is rough math, and it's difficult to prove, but I would venture to say if you pulled up a chart on any commodity, generally this overall statement is probably pretty true. Assuming that this is true, the same logic can be applied to long option, the odds of success on long options, simply because it takes a substantial price move in the futures market for a long option position to be profitable. In other words, if the market's going to trade sideways 80% of the time, 80% of the time, long option traders are probably going to have a hard time making money, and that's because, as a long option trader, options are priced to lose. So the market has to go in their direction dramatically enough to overcome the premium they've paid and the time decay, and so that typically requires a market that is breaking out of a range, not a quiet market. So it's probably not a coincidence, given the fact that we believe 80% of the time markets are trading range-bound, that most literature and most analysis suggests that the probability of an option expiring worthless is between 70 or 80%. Okay, and market direction is always a factor, whether you're trading futures or options or stocks or whatever it is, but upon the purchase of an option, there's approximately a 33% chance of a market going in the anticipated direction. And this makes sense. It's either going to go up, down, or sideways. So again, this leaves us with the conclusion that an option buyer has about a 66%, or maybe even more, based on our previous slide, maybe 80% chance of loss, even if the option's not held to expiration. So even if you are holding it for a day or two, you're not subject to a lot of time value decay and all those sorts of things, you still have a 66% chance of loss. And it's hard enough to predict the direction of the market, but to do it within a specified time limit is even more difficult. As we all know, options and even the underlying futures contracts have an expiration date. So to be profitable, the buyers must be right about the direction of the market, the size of the move, and the timing in which it's going to happen. And trust me, that is easier to say than it is to do. And there's a big difference between being right and making money. And as a trader, if you have a lot of experience trading, you'll learn that very quickly. It's very possible with any strategy to be right and still lose money. Unfortunately, that's what makes this so hard. That's what keeps everybody coming back for more. All right, but there is a time and a place for long options, absolutely. You really want to, if you're looking to buy options and you want to use that as a strategy, or even if you are an option seller or do some other type of strategy and you want to do some option buying on the side, there are definitely some opportunities there. If you look for markets with low volatility, option premium can become cheap during periods of low volatility. We like to call these lottery tickets because it's basically a snoozer market. Nobody's paying attention. Prices are depressed. Option prices are cheap. And at that time, sometimes it's worth just buying a call or buying a put and having it out there just in case there's an explosion in volatility and the market conditions change. If you do happen to be in the right place at the right time, the percentage payoff could be really big relative to low limited risk of the option purchase. And another thing to look at is extreme prices. If markets are at or near all-time highs or near multi-year highs, it's true, the trend is your friend and maybe it'll keep going up, but they tend to be prone to violent reversals at a time in which counter-trend premium is cheap. So if you see a market at an all-time high and you're not willing to sell into it aggressively, I don't blame you, but one thing to maybe think about is just buy a cheap put, and if it happens, it happens. That's great. If not, you're not out much, but at least you had the experience of being in, and potentially maybe the odds aren't extremely high, but the potential to make some good money if the market reverses sharply. Okay. Why sell options? Well, everybody you talk to is going to have a different opinion about selling options. In fact, it's a pretty controversial topic, and the reason being because option sellers are collecting a limited amount of money and they're facing unlimited amounts of risk. And as easy as the strategy looks on paper, because we've already said, okay, most options expire worthless, whether it's 80 or 60%, most of them do. So as an option seller, in theory, should be easy money, right? You're selling, you're making options, you're making money 60 to 80% of the time. It sounds easy on paper. It's not that easy, but despite the fact that it's not easy and there will be some big ups and downs, I do still believe it is the best way to approach the markets for one reason only. It allows you plenty of room for error. It's the only strategy that I know of that you can be wrong and still make money. Trading futures outright is definitely not as forgiving, and buying options is certainly not as forgiving. Okay, so why sell options? Well, again, traders are turned off by the idea of options because limited reward and unlimited risk, and they don't like margin requirements. To sell options, there is margin required. For example, if you're collecting, on a crude strangle, we'll actually look at one in a few minutes, but if you're selling a crude strangle for $1,100, you're bringing in a little over $1,000 in premium, and you pay your commission and all that sort of stuff, but the trade doesn't cost you anything. However, you do have to have a margin requirement to hold the trade. So usually, each crude strangle is different in terms of margin, but something like that, you're probably looking at a margin of somewhere around $1,500 to $2,000. So you'd have to have $2,000 approximately in your account to sell an $1,100 strangle in crude oil. That's not too bad. Now, I would never recommend, let's say you had a $10,000 account, I would never recommend that you sell 5 strangles because you have margin to do it. I think that's a horrible idea because one day the margin will go up, or one day crude will get volatile and it'll force you out of the trade prematurely. But the idea is most people don't like margin and they don't like margin calls. However, it's one of those things you have to pay to play. And if you want to put the odds in your favor, which I believe option selling does require margin, and it's very likely at some point, even if you're a conservative trader, at some point you probably will have a margin call. It's not something to panic about. I look at it as a friendly reminder as, hey, you might want to adjust some trades. Things are getting a little out of hand. But ideally, as an option seller, you want to try to keep at least 50% of your account in excess margin so that, it's kind of like a rainy day fund. In general, option selling is based on the same premise that insurance companies and casinos operate on. So, for example, they collect premium or gaming revenue, whichever it is, over time, and they collect a little piece at a time, knowing that eventually someone's going to file a claim or someone's going to hit a jackpot, and they're going to have to, deliver on a big payout. However, the idea is if they manage the risk correctly as an insurer or a casino, they will, in the long run, collect more than they are paying out. If you think about your car insurance, you're probably paying somewhere between $100 and $300 a month every month for what? Maybe it's lower than that. It depends on where you live. But in Vegas, it's pretty high. So we're accustomed to a couple $100 a month typically. But where does that money go? It just goes up in smoke, unless on the off chance that you might need it one day. So a way to look at it is an option seller is basically the insurance company or the casino. They're taking in a little bit here and there, hoping that they don't have to pay out the big jackpot at some point. But sometimes they will. Okay, we already talked about the fact that time works against an option buyer, but to an option seller, time is money. Option premium is an eroding asset to the buyer, but it's an eroding liability to the seller. As time passes, the option to buy or sell the futures contract at the stated strike price becomes less valuable, and as an option seller, that's a great thing. That's exactly what you're looking for. The last 30 days of an option life tends to see the largest pace of erosion. This is my opinion. It's probably not a fact. Every option seller you talk to might give you a different story or a different idea, but I believe that if you're selling options with more than 45 to 60 days left to expiration, a lot of times you're accepting unnecessary risk for very little reward. And what I mean by that is the option value really won't erode much. Let's say you sell an option that has 100 days to expiration. For the first 40 to 50 days of that trade, it's very possible that you see very little erosion at all on your option. It's just one of those things, you look at it every day and it's like watching paint dry. But even though it has a tendency not to erode in a sideways market, if the market goes against you substantially, it can really heat up, and if the volatility picks up, option speculators can bid up the prices and really overinflate option values. And so in other words, you're holding all this risk, but you're not really getting any reward until you get into the last 50, 60 days to expiration. So I'm not a big fan of selling with a lot of time, but again, that's my opinion. Not everybody agrees with that. All right. In theory, now people that are strictly selling options, they might look at this and think, well, heck, I've seen some pretty big swings in my account balance, and that, so how in the heck can that be less volatile? But believe it or not, if you're trading outright futures, you can see some really, really big swings in your account. And that's even if, of course you could do probably the wise thing by using less leverage. For example, if you've ever read Jim Rogers' book, he makes it sound so easy, buying corn and wheat and making money is so easy. Well, that's because he has a giant trading account, and so he doesn't have to use leverage. In fact, even though the futures contracts are leveraged, he has so much on deposit, he's eliminating the leverage. So that's a whole different ballgame. But if you're trading on leverage and you're trading futures, you have little room for error, and you're going to see some really big swings. And even if you're right about something, it's very possible you see a big drawdown before you get to be right. As an option seller, you will definitely see some volatility, but it's going to be at a lesser pace than what a futures trader might see. And if the markets are nice and calm, it might actually, at some points in time, seem like easy money, and then at other points in time, you think, what the heck am I doing? But in the long run, it's just, the idea is in the long run, you're putting the odds in your favor as an option seller. Just to make this clear, the value of an option will fluctuate with the market, but it's going to fluctuate a lot less than it would if you were trading the outright futures. For example, anybody, crude was up a couple bucks today. If you happen to be short the futures contract, you would lose $2 or about $2,000 approximately. Roughly. But if you were short an option, depending on your strike price, I mean, you might, if you're way deep out of the money option, you might only have lost 300 bucks, or maybe less, maybe more, depending on where your option was. But you get the idea. And the great thing about selling options is there's more room for error. Nobody is perfect in predicting the direction, the timing, and the magnitude. I mean, we all try, we all think we know what we're doing, but the bottom line is the market's always boss, and the market can be irrational for far longer than any of us can stay solvent. If you're trading the grains right now, you might know exactly what I'm talking about, or at least if you've been bullish the grains. Corn is actually below production costs in a lot of areas of the country, and that, in theory, is pretty insane. I mean, who the heck would grow corn and sell it at a loss? So in the long run, the market will work that out, and prices will probably have to swing back. But in the meantime, there's no limits to how crazy a market can get, and so it can get tough. But in general, That's why selling options in many cases can be maybe a better alternative, because there is more room for being wrong. And in some cases, it's very possible for an option seller to be wrong on the direction of a market and still make money. And we'll show you an example of that soon. And this is because the premium that you collect as an option seller, it kind of acts as a cushion for adverse price movements. In other words, it just gives you a buffer for being wrong. And again, we're going to show you a chart and give you an idea of how this works. The only scenario in which a short option trade is a loser at expiration is in the case of a futures price that is trading beyond the break-even point. Basically, I mean, in a nutshell, an option seller can make money if the market goes up, down, or sideways. Now, I want to point this out again, that this is all based on what the odds are and everything at expiration. And any time before expiration, things can be a lot different. And that's what makes option selling a little more challenging than what it looks like on paper, and here's why. You could just hypothetically, let's say you're short a $100 call option in crude. In theory, as long as crude stays below $100, your trade should be fine, right? At expiration, you make your max profit if crude's under $100. But if crude gets up to 97, still $3 under your $100 strike price, it's very possible that that $100 crude call that you sold earlier is worth more now than it was when you originally sold it. So even though you were right, the market stayed below 100, it's at 97, you're still on paper losing some money, and it can get pretty stressful because those, paper losses can get a little hectic and adjustments are necessary. So I just want to point out that option selling does put the odds in your favor, but that does not mean it's easy money. There's definitely always going to be challenges and things to deal with, and there's stress. Okay, somebody's asking if there's a place on the website that talks about the 20 liquid commodities for option trading. At the end, there's a couple slides at the end of this particular class that discusses that a little bit, and I'll kind of go over those. There are a few webinars, though I don't remember the titles of them, unfortunately, that are posted on our website that do cover that sort of thing. Speculators believe that a market, okay, this is an example of what a short option might look like, and this is, let's just take a step back and say, okay, here's a chart of the euro, and this is actually just a couple of days ago. Speculators might look at this and believe that the market is oversold, and they might believe it's due for a correction. They have a couple things they could do. They could buy a call option, but as we've learned in buying calls, although the risk is limited, it would take a big move for that call option to pay off for the buyer. They could buy a futures contract, which would offer the most reward, but it also offers the most risk. As a futures trader, you're immediately making or losing money as soon as you get into the market. There's really no buffer, there's no room for error. It's kind of an all or nothing ordeal. Or the third option is you could sell a put option. Okay, this was a couple of days ago, and somebody that was bullish might have thought, well, I'm going to sell a 126 put. You can collect somewhere around, we'll just call it 52 ticks. You'll notice this is Trade Navigator's option platform, and it's actually very nice. If you haven't run a demo on it, I would recommend that you do. It offers a lot of neat features for option traders. I mean, just let me see if I can. Okay, hopefully you can see this. All right. So if you notice this little icon bridge here, just gives you a couple quick pointers on exactly what strategy you're doing, and it loads based on, you can see there's a drop-down menu here, your option chain below, the Greeks, the implied volatility. So there's a lot of great tools, and then it just gives you this, which I kind of thought was cool, just a little quick rundown on what exactly you're doing. For example, if you click on the bid of the option, it'll assume that you're selling a put. This is the bid ask, by the way. These are the prices. So if you click on the bid, it'll assume you're selling, and it'll tell you, okay, this is unlimited risk. You're wanting the market to go up. This is an intermediate strategy, so it gives you just a few little clues as you're going along, and I thought that was pretty cool. But anyway, back to the example. You could potentially, this person might have thought it was a good idea to sell a euro put for approximately $650. That's 52 ticks. Each tick is worth $12.50. And the idea being, if you remember, the price at the time was around, my mouse isn't working too well. Anyway, the price was around 129 at the time. So by selling a 126 put, you're basically giving yourself quite a bit of room for error. I mean, can things go wrong? Absolutely. But the market would have to drop, you know, a good 300 points against you before you really got into trouble. Okay. Now, here's, if you do decide to continue with clicking on the bid and pulling up an order ticket, you still have another chance to verify your order in the Trade Navigator. And it's actually pretty cool. You'll notice they have, they'll show you a delta. I'm not sure you can see my cursor. Hopefully you can. But in the top right-hand corner, delta of 2172. And that's basically just going to show you how sensitive this particular option is to the current market price. A delta of 21 implies if the futures contract moves 100 points, the value of this option will move about 20. Now, the delta is not an absolute figure. It's dynamic. It changes with the market. So that's not something you want to bet your life on. But it'll give you an idea of, okay, this option is going to move about 20% of the underlying, which obviously 20% is less than 100%. So if you were trading the futures contract, you would make or lose tick for tick. If you're trading this option, you're going to make or lose about 1 tick for every approximately, actually I should say about 2 ticks for approximately every 10 ticks that the futures market moves. So you can see how it slows down the volatility. You'll also notice that they show in the middle of the screen the max reward is $656. That's how much you're collecting. That's before commissions and fees, by the way. The max risk, somebody mentioned in the chat room, is horrifying, and yes it is. That's why a lot of people say heck no to option selling. They think that's, they see the maximum reward and the maximum risk and they get frightened. And I can see why that would happen. The idea there is, though, even though the max risk is huge, it's probably very unlikely, like we just mentioned. If you're selling a 126 put, the market would have to go against you 300 points before you really started to get into trouble. 300 points in the euro is quite a bit. It gives you some room for error. If you bought the futures, you would immediately be facing a max risk of about 156, or actually probably closer to 160. So the difference is in futures, you just don't think of it that way. In options, you do. What I usually tell people is when you're option selling, the risk is theoretically unlimited, which is compliance-wise, that's true. But if you're mathematically, it's not true because the risk, in other words, the euro can't go below 0. If you were selling a call, the max risk would actually be unlimited. But if you're selling a put, the euro can go to 0, and that's the max. But the odds of the euro going to 0 are probably slim to none. Okay. Another cool thing about the Trade Navigator platform is it does show you a real quick rundown of the option analyzer. It'll show you, your break-even point. If we were in the live platform, you'd be able to scroll up and down and kind of get an idea of what the value of that option would be at expiration, given any particular futures price. So it's pretty cool. Okay, we've got a couple people asking about the platform itself. Does it give you span margin requirements? To be 100% honest, that's something you'd have to ask Trade Navigator. I'm not 100% familiar with the way their platform works. Specifically, we have the ability for our clients to use this platform connecting through a different data feed from one of our clearing firms. So On our end of the platform, yes, that it is possible to calculate span margins and estimate things before putting the trade in. So you could, yes, whether or not you could do that while logged into both Trade Navigator and ours simultaneously, I'm not sure. Or maybe Trade Navigator does it on its own. I'm not sure. You'd have to ask them. I apologize for not knowing that. Okay, so back to the example. This is just really to give you a picture of what we're talking about here. Futures traders face immediate risk of incorrect speculation. Again, somebody that bought a call would have to be accurate in the timing and the direction in order to overcome the premium erosion. But a short put trader would enjoy ample room for error because the risk of loss at expiration doesn't occur until the futures price trades below 125.48. And again, the market at this point was around 129. So you can see just how wrong you could be and still actually make 650 bucks. Again, a lot can happen between now and expiration. If the market drops to 127 tomorrow, this put will be worth a heck of a lot more money, and you'll be losing money on paper, and it's going to be stressful, and you might be doubting the fact that it's going to settle above 126. So there's a lot more to it than just simply selling and then shutting off your computer and not paying attention. But with all the challenges, again, I still believe the odds are in your favor as an option seller. Here's basically a look at the chart that we just looked at, but in a different form, and this is within the Trade Navigator platform. It does have the ability to calculate your break-even for you, and then there's a scroll bar over here on the side, which would allow you to kind of try to estimate what the profit and loss would be at expiration, and kind of give you an idea of what things would look like at different prices of the euro. Okay, now if you're not directional, like in the last example we looked at, it was basically trying to take advantage of the possibility of the euro rallying, or at least not going down any further. You may be looking at a market and saying, hey, I don't think the market's going anywhere. I think it's going to trade sideways. And if that's the case, you might want to do a neutral strategy, such as selling a short option strangle. We actually do recommend strangles to our clients in certain markets, and the reason being, if there's a big spike in volatility, sometimes you'll see option markets get really crazy. For example, crude oil does this sometimes, where it's up or down, big swings in a couple of days, and then all of a sudden you see the options just gain 10 to 30% of value just for no reason, really just because everybody's speculating, wondering, is it going up, is it going down, where's it going? And so the option market gets carried away. And you'll actually see at some instances where crude oil falls a couple bucks and the put options explode in value, but the call options don't lose value. And in theory, if crude goes down, calls should lose value and puts should gain value. But in a very volatile market, in a market where people are overreacting, that doesn't always happen. Again, the calls can sometimes actually not lose value when the market's going down, and that's when we like to try to jump in and sell strangles, because the more you collect for an option strangle, the further your break-even points are going to be, and your better your odds of success. Now, that doesn't mean we are somehow protected from some unknown, something going on in the Middle East or something else, but in general, crude oil is pretty infamous for big bouts of volatility, followed by, a couple weeks of quiet as everybody relaxes and, cooler heads prevail. Somebody's asking if you can place stop losses on option premium, and unfortunately, you absolutely cannot. And actually, I say unfortunately, but maybe it's fortunate, because the way a stop order works is it becomes a market order as soon as the price becomes part of the bid-ask spread. So it's quite possible in an option market because the bid-asks are a little wider and they trade 24 hours a day, sometimes during the overnight markets the bid-asks are very wide. So it's quite possible if you had a stop order out there, you get filled at a very inopportune price in the middle of the night while you weren't watching, and you'd wake up in the morning, you'd be really really sad about it. So for those reasons, the Chicago Mercantile Exchange won't even accept a stop order on an option. So the idea of a short option strangle is to sell an out-of-the-money call and an out-of-the-money put. Strangle writers are not speculating on the market direction. Instead, they're hoping for a lack of direction, or better yet, they're hoping for lower volatility. In other words, this is a lot like trading volatility, just as you would trade price. As a strangle trader, the nice thing about it is the trade can only lose on one side, not both. You get discounted margins. I mentioned to you a little before on that crude oil trade, which we're going to actually take a look at now. The margin somewhere, depending on specific factors, but it's going to be under 2,000, probably closer to 1,500 total margin. And that's really the reason it's so low, is because you're selling premium on both sides. The premium you collect on both sides is used to calculate your break-even. So in other words, if you collect $1,000 in premium or $1 in premium, your break-even point is $1 beyond the strike price of the call and $1 below the strike price of the put. So it gives you double the premium of cushion. The allure of short option strangles is the ability to profit from a market regardless of its direction. The risk of a short option strangle or straddle is being caught in an exploding market. And unfortunately, this can and does happen, especially if you're the type of trader that consistently keeps strangles on. We have a lot of clients that will sell strangles each and every month in certain markets, and they just kind of continually roll them out and roll them out and roll them out. And that's fine, because the good part about that type of a strategy is they're always going to be there for the good times. The bad part of that strategy is there's going to be bad months here and there, and sometimes it can be real quick. Sometimes it's volatility explodes in all the markets. It's kind of like contagion. It's wildfire, spreads from the currencies to the commodities to crude. And so if you've got strangles across a lot of markets that you're constantly in, there's going to be some pretty bad days. And then as the markets ideally, in general, not always, but generally, the markets overreact one day, and then they take a couple days to relax, and then the premium all gets sucked back in. So that's the risk of trading strangles, is just being caught in an exploding volatility market. Okay, but the odds of success for a strangle are pretty good. If you look at an example, these are using the November options. This was a snapshot of just a couple of days ago. A trader could have sold a 98 call and an 82 put and collected approximately $1,100. Now, because you're collecting $1,100, the loss zone, or your break-even point, is shifted 1.1. $1,100 in crude oil is $1.1. Each penny is worth 10 cents to a trader, so $1.10. So your break-even point is $1.10 above your call strike and $1.10 below your put strike. So in other words, this trade is going to pay out something as long as the market is between 99.10 and 80.90 about 60 days from now. Now, I don't know about you, but that looks like a pretty high probability trade to me. It can approximately be anywhere within an $18 range. Of course, high probability doesn't mean guarantee, but it does mean your odds are pretty good, right? I think we could all agree there. Now, the maximum profit comes in if the market's below 98 or above 82. So if you want to take home the entire $1,100 before transaction costs, you'd have to hold all the way to expiration, and the market would have to be below 98 and above 82. And again, I think those are also pretty good odds. I mean, that's a $16 range. Crude can be anywhere in that $16, and you get to keep your money. Now again, what happens between now and then is anybody's guess. If volatility increases, or if the market starts pushing up against one strike price or the other, things are going to get a little hectic. So it's not easy money, but again, the odds are in your favor. On a trade like this, really, if everything goes perfectly, we actually like the idea of peeling it off early. Like for example, sometimes when you get big spikes in volatility in crude, you can sell an option strangle similar to this for $1,000, $1,200, somewhere in there. And if it turns out that whatever the event the market is reacting to is not such an event, the premiums tend to almost implode. And sometimes you can get away with snatching the, buying it back at about 50% the premium within a week or two. In my opinion, if you're ever given that opportunity, if the market gives you a gift like that, you just take it and run. Because to squeeze out that extra 50%, you're hanging on to a lot of risk and a lot of uncertainty. So as an option seller, if you ever make a profit really quick, take it and run. Because the strategy in general is designed to be a long-term, slow-moving strategy. So if you get a gift, take it. And I just actually threw this slide in because I wanted to show off the Trade Navigator software. But ideally, you want to be selling options when the implied volatility is on an upswing. At these times, options are more likely to be overpriced, and they could provide you with better odds of success. So if you're selling when implied volatility is on an upswing, you're probably going to be able to get further from the market, collect more premium, and that's going to, both of those things are going to shift your break-even point further, give you more room for error. Okay, now let's talk about the reality of trading. I think I've given you lots of disclosures throughout the way, but I want to make sure you understand. We're all just one trade away from humility, and that's, if you've seen Wall Street, you've probably heard that quote. While the odds favor option sellers, they do face theoretically unlimited risk. I'm sure you probably still have the previous slide in your mind where it said risk 160,000 or 156, whatever it was. Now, keep in mind, you are facing the exact same risk, in fact, more risk when you buy a futures contract because it's the same idea. You have unlimited risk below, or theoretically. With an option, you're getting the money up front. With a future, you're not. But I totally get that you can place stop orders on futures and you can't on options, and so that's really one of the biggest factors to keep in mind. With that said, the options, typically you're going to have a lot more room for error, and typically the losses won't be as devastating as they might be on a futures contract, but again, it depends on circumstances. You just never know. Everybody's trading situation is different. In the right or in the wrong circumstances, losses on short options can be devastating. This shouldn't be shocking. Remember, we said it's selling options is similar to being an insurance company or being the house, a casino. Trust me, casinos have bad days. They have to pay out big jackpots, and insurance companies have the same situation going. But can't think of many insurance companies that have gone out of business recently with, barring the financial collapse. But I live in Vegas, and trust me, the casinos are all going just fine. So there is some logic in it. And because there's so much risk on the table, risk management and good instincts are imperative. As an option seller, it's probably a good idea to maintain some sort of double out rule, and that's kind of a mental stop. If your option doubles in value once you sell it, sometimes it's a good idea to at least reassess the situation and consider making some sort of adjustment. However, I just want to point out it's not always that easy. There are some times that markets move really fast and options triple in value in the blink of an eye. So this is a simplistic rule, and it's probably a good rule to double out, but you want to keep in mind that it's not going to be, trading's not black and white. There's lots of gray areas, and so there's going to be lots of decision making. It's not all a nice, fancy, clean equation. One strategy that traders might consider, and this is for those that are well-funded and those that can mentally handle this sort of thing, but sometimes the best thing to do is to actually sell more premium. If you're in a trade and the volatility spikes and the options gain a lot of value and you're sitting on a big paper loss, sometimes if you've got the guts and you've got the money, it makes sense to sell more premium. And it's kind of like a dollar cost averaging type of ordeal. If you had deep enough pockets, it's probably possible to sell your way out of anything. But but of course most people don't have deep enough pockets, so you don't want to pretend like you do. You want to be careful with that sort of thing. Another thing you could do to manage your risk is cover futures contracts, or I'm sorry, cover your options with futures contracts. This can be kind of dangerous, but it can be effective. I would tend to recommend if you do that sort of thing, instead of doing 1-for-1, you might want to do 1-to-3. So for example, if you're short calls in crude and you get into trouble, the market's running up against your call options, let's say you have you're short 3 calls, you may want to buy 1 future against it. That way it at least stops the bleeding. It puts you in a, depending on where your strikes are and things like that, it might put you in a delta neutral situation to where you know, you're not really losing money as the market goes up, you're not really going to make a whole lot back as the market goes down, but as time goes by you'll get some of that premium erosion. I would have a hard time recommending, if you're short 3 call options, that you buy 3 futures, because it leaves you a whole lot of risk on the downside. The market has a relentless and annoying habit of turning around at the exact wrong time for that sort of thing. So it'll be, you know, it's Murphy's Law will require that as soon as you go long 3 futures against your 3 call options, the market will turn around and drop $2. And now not only are you losing money on your options, but you're also losing money on the futures that you put on to protect your options. So again, it can get a little messy, but ideally with experience, hopefully you can ride some of these trials out. A third way of hedging short option risk, and this is actually something that looks really, really good on paper, but in an exploding market it can do more damage than good. But a lot of people do it, and so I just wanted to throw it out there. It's a 1-by-2 ratio, right? It offers intrinsic insurance, but poses problem if there's a continuation of the volatility explosion. I'll tell you what this means. Let's say you're short 1 call option in crude at $100. And the market's trading, let's say it's trading 99, so you're getting a little worried about your option, but you don't want to get out because you feel like you'd be locking in a loss prematurely. So to hedge yourself, you might consider buying a 102 call and then selling 2 104 calls. Okay? On paper, this really basically limits your risk above 102 until we get to 104. Because you're going to be making money on your long 102 call up to 104, and then at 104 you're short 2. That's the problem. If you're not only wrong, but you're super, super wrong, and the market goes above 104 on your ratio, you're dead meat. But on paper, again, it's almost like free insurance. So normal market conditions, it can be a fabulous tool, but if you happen to be in the wrong place at the wrong time with a ratio right, covering your short option, it could be torture. Okay. There are a few markets that generally should be avoided as a short option trader. These are a handful. There's more on the list, but this will just give you a good idea. You really want to, it's really not that hard to find which options are viable. Pull up an option chain, look at the bid asks. If it's reasonable, then it's probably a good market to trade. If it's unreasonable, especially if you're looking at, you know, during normal market hours, if you're seeing wide bid asks, just shut the chain down and go to the next market. It's probably not worth it. But here's a few that people talk about them on TV all the time. You hear all kinds of stuff about them. You would assume that they're liquid, but they're not necessarily liquid, and they probably should be traded sparingly. Lumber, unleaded gasoline. I'm just going to point something out on unleaded gasoline. If you pull up an option chain on unleaded gasoline, you'll notice the volume on each strike price and the open interest is actually pretty high. So it kind of gives the allure of being a very liquid market, but what you probably don't realize is most of that volume and open interest is commercials or hedgers, and they're doing 1,000 contracts at a time. So for a retail trader trying to trade, you know, 1 lot, 10 lots, whatever it is, good luck getting a fair fill in that market. Even though thousands of contracts are trading, they don't care about your 1 lot order or your 2 lot order. You're going to get completely hammered on the prices. So I would recommend trying to stay away from that market. I mean, unless you just absolutely see something you can't pass up, but I would probably just drop it off the list. The meat, so live cattle, feeder cattle, hogs, I'm not saying don't ever trade them, but be careful with them. A lot of traders like it because the margins are really low, especially if you're selling options. You can sell a lot of options for a very low margin, but because of liquidity, they can move pretty erratically, and the options can be a little scary at times because, quite simply, you know, sometimes you can't get in and out at fair prices. Coffee is another one of those. In fact, really all of the softs. Sugar is pretty liquid, but the options aren't that attractive for option sellers because they tend to be cheap. In fact, I actually think sugar is probably an option to be buying options in as opposed to selling most of the time. So coffee, OJ, cotton, those types of things you really want to trade sparingly when it comes to options. Oats and rice, for the most part, stay away. And the CRB index, for whatever reason, I've seen a few people that just absolutely had to trade the CRB index because they talk about it on CNBC, but let me tell you, even if you can get into the market, you're not going to be able to get out. And if you do get out, it's going to be at a price you're probably going to have a hard time living with. The markets that I think that you should probably focus on that have liquidity to handle option selling or spread trading or whatever it is that you're doing, even the S&P, the Euro, the Treasuries, so that's the 30-year bond, the 10-year note, crude oil. Gold is okay, but you don't want to get too heavy in gold because it can be a pretty treacherous market at times. Corn and wheat are very liquid. They haven't been the best markets to sell options in recently, but normally they're actually pretty good option markets. And as far as the other currencies, I mean, the yen, the British pound are okay. You don't want to go heavy on any of those. But generally, again, if you just pull up an option chain, you'll get a really good idea of which markets you should probably stay away from. If you have any questions or comments or anything like that, we'd be happy to talk to you. You can shoot me an email, cgarner@decarleytrading.com. Check us out on Twitter. We post samples of our newsletters, charts, commentary on Twitter and Facebook all the time. So the Twitter handle is @CarleyGarner. On Facebook, just type in DeCarley Trading and we'll come right up. And if you have time and you're interested in learning more, if you go to decarleytrading.com, on the right-hand side of the website, there's a tab that says Research, and I think it's the second or third one down. You'll find webinar archives, and we've got lots of videos for you. I think there's about 20 videos, so if you've got time and you want to learn, there's the information. All right, somebody's asking about silver. I am glad someone brought that up because I had totally forgotten about silver. Silver is actually a very popular futures market for good reason. There's volatility there, and there's lots of interesting things going on in silver. But when it comes to options, they are highly, highly, highly illiquid. And honestly, I'm not sure it's because there's a lack of traders. I think it's just the way that the exchange lists the strike prices at every nickel. I just think there's too many strike prices to spread the liquidity around, and so it ends up becoming the options are almost untradeable. I mean, it's very typical on the front month that you see a bid-ask spread of 4 cents, which is like $200. So I'm not a big fan of trading silver options whatsoever. You really, if you're going to trade them, don't sell them, buy them. And if you're going to buy them, go cheap because it's going to take a huge, huge move for you to just overcome the bid-ask spread. Okay, someone's asking if it was recorded, and I do believe it was recorded successfully, so I think we're good to go. Hopefully we'll get a link out to you as soon as possible. Okay, somebody's asking about our brokerage fees. Again, DeCarley Trading, we are a brokerage firm. We offer anything from full service to discount online. As far as commission rate goes, we tend to work with each client individually. It's based on volume, account size, how much service you want, that sort of thing. But just to give you very ballpark ideas, full service, starts at 25 to 30 bucks depending on exactly what you're looking for. That's round turn. Discount online goes, well under 10. Just again, depends on what you're looking for. So if you shoot me an email and give me a little bit of information, I can give you a precise quote. Just tell me what account size you're trading, what exactly your strategy is, how much help you think you might need or not need, and we'll make sure you get a precise number for you. Someone's asking if we clear through Thinkorswim. No, we do not. We're a branch of the Zaner Group, and we're what's called an independent IB. So we can clear through multiple brokerage firms. Thinkorswim or TD Ameritrade is not one of them. They're a stock firm that offers futures on the sides. We are a futures firm that doesn't offer stocks. So we specialize in this area. It's, I would venture to say that we're probably quite a bit more efficient than a firm, a broker-dealer that's handling stocks and futures. So there's my sales pitch. But we have a lot to offer. So if you're interested, shoot me an email and I'll give you some ideas on what it is we do. Okay, somebody's asking if they should trade stock options before trading commodity options. I don't necessarily think so. I think if you're going to trade options, pick which market you think is going to work out best for you. And I actually, I'm biased because I'm a commodity broker, but I think if you're going to trade options, I think commodity options are a better place to be because of the things we mentioned before: tax benefits, higher risk-reward profiles. It takes a lot less money to trade it because of the way the margin accounts work. Someone's asking if we operate similar to Infinity Futures. The answer to that, similar in that yes, we offer brokerage services. We do offer online trading. So if you don't ever want to talk to a broker, we can set you up with a platform and you can trade away. So in that manner, yes, we are similar to Infinity. But of course, obviously, we offer kind of an entirely different service package. Like our online traders, get a lot of service, additional services that we provide. So if you're interested in that sort of thing, shoot me an email. Or better yet, a good idea would be to sign up for a free trial of our newsletters. You can do that at decarleytrading.com. And that'll give you a really good idea of some of the things that we do here. Somebody's asking what our monthly fee is. We ourselves are a brokerage and we work on commission, so it's a per trade commission. If you're talking about Trade Navigator's monthly fees, you're going to have to ask them. Unfortunately, I'm not in a position to give you that information, simply because I don't know exactly. I think there's a lot of factors determining that. So, all right. I appreciate everybody coming. It was a pleasure to be here. I appreciate Trade Navigator for letting us come and talk to you guys today. If you have any questions at all, please don't be shy. Shoot me an email or give me a call.